This video is for educational purposes only and should not be considered financial advice. The higher time frame will keep you out of bad trades. Welcome back to our channel. In today's video, we're diving into a crucial trading strategy using higher time frames to frame your trades and lower time frames for entry points. This approach can significantly improve your trading success. Let's break down why this is so important and how you can apply it to your own trading. The higher time frame context. Firstly, the higher time frame will keep you out of bad trades. But what does this mean? Higher time frames allow you to see the bigger picture, including when price is consolidating. In contrast, lower time frames can often deceive novice traders and entice them into false setups. By focusing on the higher time frames, you can avoid these pitfalls and make more informed decisions. When you see a higher time frame for your setup model, you get a clearer view of market trends and consolidation zones. As we see here on this daily time frame, this is a consolidation zone here in the middle. This helps you identify the key levels and trends that truly matter. However, when it comes to placing your entries, that's where the lower time frame comes into play. Lower time frame noise. It's important to remember that when you place your trade on the lower time frames, the price will invariably go against you at some point. This can be unsettling, especially for new traders. But here's the key. Stay focused on the larger time frame. It provides context and helps you remain confident in your trade setup, even if the price momentarily moves against you. As we see here, we have the same time frame that we had on the daily. All of that consolidation that was going on is happening right here. And price moves up and down both ways, and traders are being taken out, losing their accounts. You have to tune out the noise on the lower time frame as if you were at school and you're hearing all the kids yelling and the school sounds around you. The only sound you are waiting to hear is the school bell that dismisses class. Once that happens, everyone gets up and leaves the room. That's the higher time frame in action. It tells everyone when to move and where to go. Planning a clear stop loss. Another crucial aspect of using the higher time frame is having clear, definable rules for your stop loss. Your stop loss should be based on a key higher time frame level. This makes it very clear when a certain price move will invalidate your trade. A well-placed stop loss can protect your capital and keep you in the game longer. Using mitigation blocks in higher and lower time frames. This is why we love mitigation blocks. They create clarity in your trade setups by providing clear stop loss and entry points. Let's look at a few examples of how mitigation blocks can be used for clear stop loss and entry setups on a higher time frame, and then we'll see how the lower time frame can give us an optimal entry and a tighter stop loss. Here on this higher time frame chart, you can see the mitigation blocks. These zones help us define our entry levels. This is a weekly chart, and we see the bullish mitigation block here. We've also drawn out the 50% of the range. These points are also very helpful. They are key turning points in price action. Now switching to the lower time frame, we can see how these mitigation blocks influence price action and provide precise entry points and tighter stop loss levels. Here is that weekly bullish mitigation block. Price dips down to it on a daily chart and reverses. So instead of having all of this move right here as your stop loss, you can wait for price to reverse from touching the bullish mitigation block. One good way to plan an entry is to wait for the candle that touched the mitigation block to finish and then as price moves above that candle, you can enter. This is a daily chart. Again, here is another lower time frame, the hourly chart. Here is that same bullish mitigation block. This is where the daily candle tapped into that bullish mitigation block. And as we said, we can look for an entry up here if we're just playing that simple strategy. And if you enter right here, when price opens again the next day, you would have to deal with all of this drawdown. That's why going to the lower time frames helps you to plan your entry better. So once price makes this move all the way down, we see it touches that bullish mitigation block again. This is also coincidentally the 50% of the range of this order block. And as we see, price bounces right back off of that and then creates another bullish mitigation block. Then it comes right back up, closes above that bullish mitigation block, and your entry could be right here as it retraces back into it. Now, why would price retrace back into this bullish mitigation block? Well, look over to the left and you'll see a bearish mitigation block. This one and this one. And to define our mitigation blocks, if you haven't gone back and watched our other videos, for a bearish mitigation block, you have a high, a low, and a higher high. This is another high and a low and a higher high. So we actually have two bearish mitigation blocks. So once price taps into this bearish mitigation block, it goes down. Then it taps into this bearish mitigation block again and goes down. Well, we like to count the number of mitigation blocks. So even though you're still hitting the same levels, if you count 1 and 2 bearish mitigation blocks, you have 1 and 2 taps into both of those mitigation blocks, thus also creating equal highs. Once price taps right back down into this bullish mitigation block, we can enter and look for these equal highs to be taken out. And this is your highest probability entry and your tightest stop loss. Because if we look, our bullish mitigation block stop loss would be down here, as opposed to all the way down here if you were using the daily chart. So using the lower time frame gives you tighter stop losses and better entries for less drawdown. Here is one more chart of Tesla. As we look on a daily chart, we see a bullish mitigation block and a bearish mitigation block. Price moves past this bullish mitigation block and then taps into the bearish one and comes down on a daily chart. Let's look at these on a smaller time frame. And here we have the hourly chart of Tesla, where you see price breaks above that bullish mitigation block. Then it taps right down into it. Once price breaks above a swing high, you can look for a retracement back into an order block or a mitigation block. In this instance, we just have an order block, a very large order block. We can enter here and then wait for price to go all the way up to the bearish mitigation block. If this entry was not palatable to you and you need a mitigation block, you'll get one down here where you have a low, a high, and then a lower low. You also have another one here, a low, a high, and a lower low. And so you can place your entry here off of this level, which is the same one as this order block, and wait for price to go all the way back to this bearish mitigation block. And what's great about this lower time frame entry is that your stop loss is down here, and you don't have to have a large drawdown. Price does come back against you here, but then shoots all the way up to your TP. Now, if you're looking to take that bearish mitigation block the other way, you see we have price breaking structure here, and then we have a high, a low, and a higher high, creating a bearish mitigation block. with your entry right here. Now, you have to look at what's going on in context. Because if we look, we can see this bullish mitigation block right here. I didn't draw it out, but it's obvious. Once price moves down, it's going to respond to a mitigation block. So right here, price goes all the way back and takes this liquidity, stopping you out if your stop loss was right here. So you have to pay attention to the context. Yes, we hit this bearish mitigation block, but all of our bullish mitigation blocks have not been mitigated. This one especially. So all of these over here have been mitigated. And the only one we're looking for is the one down here. We have a low, a high, and a lower low. And if we draw the line out, that's where price ends up. So price comes back, takes liquidity, and then moves lower. Your real entry from this level would be right here, where you have one bearish mitigation block, another one, and another one. And you don't know where price is going to respond from. So you can take the first mitigation block, but you just have to have a larger stop loss. And once we put our stop loss up here, we know that we're looking for at least a 2-to-1 and most likely a 2.5. So price moves down and goes all the way to where we thought it was going to go and lower. What you can do is target 50% of the order block or mitigation block, and that's where price moves to. To recap, trading your setups on the higher time frame keeps you out of consolidation zones and provides context for your trade. The smaller time frame will give you key details on how price is reacting at certain levels, which is where you should place your trades. This combination of higher time frame analysis and lower time frame execution is a powerful strategy for any trader. Thanks for watching. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more trading tips and strategies. Don't forget to hit the notification bell so you never miss an update. Until next time, happy trading.